Hey guys, investing in the stock market is more popular than ever before, especially at this time where we have seen historic falls in the stock market. One question I get asked a lot is how to analyze a stock before investing. So today I'm going to share with you guys 10 things that I think you need to look at before you actually take the step to go and invest in a stock. This goes beyond the qualitative things that we might ordinarily be aware of when it comes to various companies, such as the brand awareness of a company or perhaps the leadership of a company. So today I'm going to dive in and kind of unpack some of the numbers that I think are absolutely critical in helping you take that step to buy a particular stock. My name's Ken of the Humble Penny and Financial Joy Academy. What we do on this channel is give you the tips, the insights, the practical hacks to help you work towards a dream life of financial independence and money joy. These ideas I'm sharing today are things that I've picked up over the last 10 years, and these have helped me gain confidence in being able to invest successfully in achieving some of my life goals. Although this list today is not a complete list of things that you need to check, I believe these 10 areas I'm going to talk about today are key for helping you really get stuck in and do the research that's necessary to gain confidence with investing. Okay, I've always talked about the need for research when it comes to investing in stocks or funds or all kinds of investments. So beyond the ordinary qualitative aspects of investing in a company, these quantitative areas we're going to look at today should help you essentially improve your knowledge about investing, as well as give you a lot more confidence as you grow on your journey as an investor. All right, let's dive straight in now and look at these 10 things that I think you need to understand before you start investing in stocks. So the first thing to look at is the company share price, okay? So I typically look at two main things when it comes to the company share price. First is I look at the share price over a period of, say, 5 years. And the reason I do this is so that I can see the general direction of this company's share price over a period of time. Now, 5 years is usually considered to be a fairly decent period of time over which to kind of look at a particular stock or company, okay? So I look at it just to see what the volatility has been over that period of time and to see how well this company's share price has increased or even decreased over that period of time. The second thing I look at when it comes to the share price is to look specifically at the buy price and the sell price of that particular stock and to see how close those particular numbers are, because usually when those two numbers are fairly close together, it's an indicator that that particular stock is fairly liquid. By that I mean, it means that many people are buying and selling that particular stock, which means that if I was to buy into that particular share and held it for a period of time, when I want to sell it and get rid of it, it would not be a problem because that particular stock might have a lot more liquidity. The closer those two buy and sell numbers are of a particular stock, the better, because it indicates greater liquidity. And the more far apart those numbers are, I'll put an example on the screen for Apple, and the further apart the buy and sell prices are, the more it indicates the lack of liquidity in that particular stock, i.e. people aren't buying and selling that particular stock as frequently. I'm going to put an example on the screen of Apple, a very popular stock with many people who perhaps use Apple technology day to day. And as you can see on the screen, that particular stock has a buy and sell price of $310. And you can see there's very little difference between the actual price that you can buy that stock and the actual price that you sell it, which indicates that this is a highly liquid stock, one that you might be able to buy into, hold if your strategy is to buy and hold, and then sell over a period of time. The second thing to look at is the earnings per share, okay? Now, this is essentially an indicator of how much in profitability a company makes for each single share of its stock, okay? It's a simple calculation, which I'll put up on the screen, that compares the earnings of a company to the actual share of that company, okay? So the higher this number of earnings per share, the better, because it's an indicator of the profitability of a company. It's also a decent guide for you as an investor because you can compare the earnings per share of a company from one period across various years, for example. That then gives you an idea potentially for what expected future earnings are from that particular company. And you would then invest your money with the confidence that you'd expect much better returns in the future because that company potentially has been performing well over time. I'll put up on the screen a chart of an earnings per share comparison I've found across various tech companies. It's interesting to see, if you look at that image, how the earnings of those companies move from one year to another, okay? Typically, a lot of these tech companies, such as Amazon and Google, have done very well over the years with their earnings, i.e. their profitability, increasing from one year to another. And this serves as a really good indicator for these companies to generate future higher earnings as time passes. Before I carry on, I just want to spend a couple of minutes to thank the sponsor of today's video, IG. I was joined by Skirmy, an influencer who's keen to get started with investing in stocks and had a few questions for me about share dealing. Hey Skirmy, how are you doing?
I'm doing great, thanks Ken. So I have a few questions that I hope you'll be able to answer before I get started.
Good.
So I was wondering, how do you get started with share dealing?
Great question, Skirmy. There's never been a better time to get involved with the stock market through share dealing. My suggestion is to begin by setting yourself some long-term goals first, okay? Then that goal can then be followed by a particular investment strategy. It could be that you are buying shares for dividend income, for example. Then you want to start to research into particular companies that you want to invest in, and then you want to follow that by deciding how much money you want to put into shares through share dealing.
That's great, thanks Ken. But what about the costs and fees for share dealing? How much would I be paying?
Okay, so you can get started with zero commissions with someone like IG who offer that to their active traders. Okay, provided you meet their minimum requirements for the previous month, it can make this a really affordable way, an easy way to get started with investing in some of the largest companies around the world. In fact, let me share my screen and give you a bit of a demo of their share dealing account. Okay, so here's IG. They are a reputable company and have been in the investment business for many years. As you can see here, you can open a share dealing account just here, and they give me a bit more information about this particular type of account. You have a huge choice of investments, over 10,000 shares, funds, and investment trusts that you can actually get started with investing in. Again, low cost, as I mentioned earlier, zero commission on US shares. You can open an account in less than 5 minutes using their award-winning app. And it wouldn't be long before you actually find yourself getting started with share dealing.
That's fantastic. Thanks a lot, Ken. That's very clear, and I cannot wait to start with investing my money. Thanks so much.
Take care, Skirmy.
Take care. Bye.
Okay, the third thing to watch out for is the PE ratio, or the price earnings ratio. So as the name implies, it's a ratio of the share price of a company to the earnings per share. So the earnings per share is one of the metrics we covered earlier in this video, okay? What's really interesting about this particular metric is that it's an indicator of confidence in a particular stock, okay? So the higher the PE ratio, the better, because it indicates confidence that the company is likely to do well in the future. So I'll give you a very good example of this. Let's say that a company's share price is £100 per share, and a company's earnings per share is £5. Okay, let's say those are good examples. Okay, the PE ratio, the formula is the share price of a company divided by the earnings. Okay, so in this example, it would be £100 divided by £5, okay, which means the PE ratio will be 20 times. Now, essentially what this number means is that as an investor, you and I are willing to pay up to 20 times the earnings, i.e. the profitability of a company, because we believe that in the future, that company's profitability would do even better than what it is right now. Okay, so the PE ratio of a company is an indicator of confidence. Okay, you really want to be looking out for PE ratios of 10 and above in any company that you want to invest your money in. Number 4 is the market capitalization. This essentially refers to the equity value of a company. In simple terms, it's the share price of a company multiplied by the number of shares outstanding. Okay, so it's a price multiplied by the quantity, the number of shares that exist for a company. Okay, that number then gives you a figure which we refer to as the market cap or the market capitalization of a company. Now, in my experience, the bigger that number, the better. I typically might look into companies that have a market cap of at least £1 billion, okay? Because those companies are typically well established, they're typically blue chip companies, and such companies are ones that might actually have a strong enough balance sheet to be able to pay you a dividend over time. Number 5 would be the dividend yield. Okay, this is a really important metric if you are somebody who is investing in stocks for dividend income. Okay, there are lots of dividend income paying stocks that you can explore potentially as part of your portfolio. The dividend yield is a ratio of the dividend per share to the company's share price. The number you get will be a percentage. Okay, essentially the return that you are getting from investing your money in that stock that then pays you a dividend. Okay. Now, ordinarily, a really high dividend yield is a good sign, but it can also be a bit of a red flag. Okay. I would typically say that a dividend yield of up to 8% is considered reasonable and sustainable, i.e., you get up to an 8% return from dividends by investing in that particular company. Now, the thing about the dividend yield is that, as that formula indicates, which again I'll put up on the screen, is that if the bottom number, i.e. the company share price, if that number was to be decreasing from one year to another, it could potentially come across misleading that that company is paying a higher dividend yield, i.e. a high number on top divided by a lower number at the bottom leads to a much higher dividend yield potentially. So as I mentioned at the beginning of this video, you do want to then spend some time looking at the movements in the company's share price, because if the share price has been going down from one year to another, and if you notice the dividend yield going up from one year to another, it's a red flag that that high dividend yield that you might think is a good thing is driven by the falling share price from one year to another. But remember, watch out for about 8% as kind of the top end from a dividend yield perspective, because any company paying more than 8% from a dividend yield perspective raises a question of potential sustainability in being able to maintain those dividends from one year to another. Okay, so this next one to watch out for uses numbers from the balance sheet of a company, and that is to work out the current ratio of a particular stock. Okay, and this is really important. So the current ratio essentially is an indicator of liquidity. That means the ease with which a company is able to use its available assets to convert them into cash, or to, as time passes, meet its current liabilities over time. Essentially, their ability to pay down their debts over time. This is what the current ratio is testing. And then the ratio is worked out simply by comparing the current assets of a company to the current liabilities. So let me just explain what these are. So the current assets of a company, which you see on the balance sheet of a company, are essentially the short-term assets of that company. They could be things such as the cash that that company has, or it could be the debtors, i.e. amounts owed to that company periodically. It could be payments made in advance by that company. It's called prepayments. These all come together and form what we refer to as the current assets of a company. Okay. Now, the current liabilities of a company are liabilities that are due to be repaid in less than 12 months. Okay. So these could be overdraft balances or short-term loans that a company is due to repay over a period of time. So if you take the total of the current assets, which you'd find on any company's financial statements, divided by the current liabilities that you'd find again in a company's financial statements, you should get a number. Okay, and what you ideally want is for that number to be at least 2. Okay, because it's a really good indicator that the assets, the current assets of that company, cover the current liability at least twice. This gives you comfort that this company has the capacity to meet its liabilities, things that it owes, over a period of time. The really good example of this is if a company has current assets of say £8 million and they have current liabilities of maybe £4 million, 8 divided by 4 will give you 2 times, which you'd look at as an investor and say, okay, I think this is actually a comfortable enough current ratio for a company. So therefore I have some comfort that this company is strong enough and has the ability to meet its liabilities over the short term. Next is to look at something called the quick ratio. Okay, so this takes the current ratio I mentioned above and takes it a step further. Okay, I'll give you an example here. So there are many companies out there that have a lot of stock on their balance sheet. Could be fashion companies, maybe like Burberry, for example, or maybe airline companies, perhaps like British Airways and so on. All these various companies potentially have a lot of stock on their balance sheet. Okay, so what the quick ratio does is that it takes the current assets of a company and strips out the stock. Okay, so that all you have left are just the cash, the debtors, the prepayments of a company, basically the bits that are necessary for quick conversion to cash in order to pay down the liabilities. Okay, so it takes that current ratio number we worked out in the previous part of this video, takes it a step further by stripping out the stock to see what that ratio looks like. Okay, so as an example, imagine we still had £8 million of current assets, but this time around we've got £2 million of stock. So 8 take away 2 leaves us £6 million of current assets less the stock. Now if we divided that number by the current liabilities of 4 million, we would end up with a quick ratio of 1.5, i.e. 6 million divided by 4 million. Now, a number like 1.5 is considered reasonable, although it's very important to compare that number for a particular stock over a period of time, as well as compare it to the same number for other companies of the same peer of that company, i.e. perhaps compare that number to an industry average to see how that compares before perhaps making an investment into a company. Next is to look at the debt to equity ratio of a company, okay? So it's very easy for a company to look successful, but at the same time to be taking on a lot of debt to finance their operations. So the debt to equity ratio essentially compares the short and long-term debts of a company, takes those numbers, you bring them together into one number, and then you divide that number by the equity in a company, what we refer to as the shareholders' funds, okay? Which again, you see as a number on the balance sheet of a company, okay? Now, the number you get here gives you an indication of what proportion of the total equity is made up of debt, okay? The reason this is important is because if a company is taking on a ton of debt, what inevitably happens over time is that that company has to pay that debt back, which might be reflected in the company's financial statements by higher interest expenses that go through the profit and loss, i.e. the P&L of a company. And obviously, if a company is paying out a lot in interest, it leads to lower profitability and therefore potentially much lower potential for dividends to be paid out to you and me as investors in that particular company. So you want to keep an eye on the debt levels of a company, just as you would keep an eye on the debt levels within your own personal life, and ensuring that debt does not make up a big part of your overall net worth. The net worth in your life is the same as what we would refer to as the shareholders' funds or the net assets of a company. So as an example, if the total debt of a company is say £5 million and the total shareholders' funds or net assets of a company is £20 million, the ratio would be 5 divided by 20, which is the same as 1 divided by 4 or 0.25, which is considered to be a fairly decent debt to equity ratio. But again, for that number to make sense for you as an investor, you'd need to compare that to other companies within the peer group of that company, or potentially to an industry average for that particular company that you're looking to invest in. Number 9 is to look at the return on equity for a company, okay? This is a very simple calculation. They essentially look at how effectively the management of a company are using the assets of a company to create profits for that company, okay? So you and I would love to know that the companies we're putting our money into are working very hard and turning those assets into creating more profits for that business that we've invested in, okay? So the higher the return on equity number, the better. And the calculation is simply to take the net profits of a company, i.e. profits after paying tax for a company, divided by the shareholders' equity of a company. That gives you a percentage, and the higher that percentage, the better. A good proxy for the return on equity is to compare it to the long-term average return on the S&P 500, which has been around 14%. But more generally, anything below 10% is generally considered to be a fairly poor return on equity. But again, this varies depending on company peers and on industry averages. Now, the final thing you should be looking at is the costs of investing in a particular stock over time, okay? So there are 2 main costs you want to be watching out for here. The first is your dealing cost for investing in a particular stock. Dealing costs are costs that you essentially incur by making an investment into a particular stock. Essentially, there's a cost for making the investment as well as the cost for exiting the investment. These can vary from 0 commissions, as I mentioned to you earlier, for US stocks, or up to about 11 or 12 pounds, depending on what provider you choose to buy your stock through. The other charge to watch out for is the management charge that you have with your brokerage account. Essentially, the charge that you get for holding your stock in a particular investing account, such as a stocks and shares ISA or a self-invested personal pension, a SIP, for example. That number is usually charged as a particular percentage of the value of your investments once a year, typically. Guys, I really hope you've enjoyed this video today on the 10 things I think you should take a look at before you go ahead and invest your money in a particular stock. That list is by no means a complete list, but by taking a look at those various areas and gaining confidence in your process of researching a company, you will over time get better at investing and, above all things, actually enjoy the process of researching companies, funds to invest your money for the long term. I'd love to hear from you in the comments below. Tell me, what are you currently considering investing your money in right now? Is it stocks? Is it funds? Give me an idea of what you are currently investing your money in right now. And more importantly, I'd love to know from you why you are investing in those particular stocks or funds, index funds or ETFs, and so on. If you've enjoyed this video today, please hit that like button because it really helps encourage other people to support our channel. If you're new to our channel, hit that subscribe button and that notifications bell because it helps to get you notified when we publish content twice a week on a Tuesday as well as a Thursday. Thank you guys so much for watching this video, and I hope you enjoy this journey towards investing your money, doing the research, thinking long term, and becoming a more confident investor. Take care, and I look forward to seeing you again on our next video. Bye bye for now.